Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks, live from the SIBO floor, Global Markets. I have two paper money trades for you today on two high-profile names, both in the news, both busy this morning. First, we'll look at Supermicro. Supermicro is currently up about $6, about 14%, 12.5%, sorry, as we get to the 9 o'clock hour here in Chicago. This stock, remember, came out with earnings and a new corporate update last week, and the stock has been moving on the upside since then. Sort of a relief rally that the news wasn't horrible, but looking forward, here's a paper money trade to look at in Supermicro, and it is sticking in the call diagonal family. Looking at Supermicro now, looking out till the March 14th expiration. So giving yourself some duration on this trade, 4 full weeks, actually 3.5 full weeks, and buying the March 14th 55 call, and then selling this week's February 21st 60 call. So the 55-60 call diagonal in Supermicro. Now, we put that in at $5.50. It's trading pretty close to $5 and trading a couple pennies higher than that now. So couple things. You've got some duration on this trade. The March 14th expiration is 24 full days, so over 3 weeks on this trade. That's going to cost you a little. The trade-off here, it's going to cost you in terms of the net debit on this trade. If you want that net debit to be lower, move that long strike up closer to expiration. Right? You can go to one of the earlier expirations. So the max gain on this trade is something at or around $60 on expiration day, right? But you're paying more than $5 for a $5 diagonal, which means you do have to manage it if it were to get up near the $60 strike. So remember, the risk on any diagonal like this is the debit paid. You're collecting theta on this trade, but you have to be cognizant of a violent move to the upside because you paid more than the width of the strikes. It has some of the characteristics of a call calendar, which means the earnings will drop back down as you go through the 60 strikes. So be cognizant of that if you're using this call diagonal. That gives you about 27 long deltas. Okay, that's our first trade. The second trade, Nvidia. Now, Nvidia has another interesting story because it has earnings coming up on Wednesday, the 26th of February after the bell. What does that do for the options? Well, the post-event options are trading at a higher volatility than the pre-event options. What do I mean by that? Now, the paper money trade we looked at, I'll explain that in a minute. The paper money trade we looked at is buying the March 7th, that's the week after the event, the 140 call, selling this week's 145 call. Now, remember I told you about more debit than the width of the strikes? This one is that way too. I put it in at 760. It's trading about 750. It's actually trading a little bit lower, but it's a bigger debit than the width of the strike. So you have to be careful. Why is that? Well, the March 7th expiration, which is post-event, trading about a 67 vol. This week is trading about a 53 implied volatility. Well, why do that? Because after this week, if you were to extend duration into the earnings event, that credit that you roll that strike for will be a large one because you're basically selling a 77 implied volatility. That's if you did it today. Later in the week, it may be even more expensive. So back to our trade, buying the March 7th 140 call, selling the February 21st 145 call. The risk on the trade is the debit paid $7, we'll call it $7.40 now. You're collecting a little bit of theta, not as much because of the difference between the two implied volatilities, but you're looking for a move this week towards the 145 strike as Nvidia continues to make its recovery. Now, remember, that earnings event is going to be significant, so make sure you know the dates on the events like this. But Like I said, you're about 28 deltas long, and the risk on this trade is the debit paid. All right, that's our show for today, everyone. I'll see you tomorrow with another edition of Daily Trader. I'm Kevin Hincks.